Hello everyone, and welcome to this week's FX market review from SC Forex Insights. This week, the global foreign exchange market presented a clear pattern. The US dollar stood out as the sole outperformer, while non-US currencies faced broad pressure. The US dollar index continued to strengthen. Among major non-US currencies, only the British pound held up relatively well, while the euro and all commodity currencies traded lower across the board today. Based on our weekly currency strength charts, we will first break down the performance of major currencies throughout the week. Then focus on the US dollar, which has dominated the market for 2 consecutive weeks, to unpack the underlying logic behind its persistent strength. 1. Overview of major currency performance this week. Based on the weekly currency strength landscape, combined with strength readings and price action, we can clearly categorize currencies into 3 groups. The US dollar claimed the top spot as the strongest currency without any doubt. Its strength remained in an elevated range throughout the entire week, with a clear and dominant lead. Driven by both the inflation surprise and rising risk aversion midweek, its strong position remained extremely solid. The Canadian dollar was the worst performing major currency this week, finishing at the bottom of all G10 currencies. On the daily chart, the Canadian dollar traced a classic rally then fade pattern. It was also the most volatile currency this week, hitting fresh weekly lows and forming a stark contrast with the US dollar's strength. Besides the Canadian dollar, the Swiss franc also recorded relatively high volatility. Overall, the core volatility in this week's FX market was concentrated in commodity currencies. The weakness in non-US currencies was essentially a mirror reflection of the US dollar's strength. Point 2, deep dive, fundamental breakdown of the US dollar's sustained strength. Given the US dollar's standout performance this week, we selected as the subject of our deep dive to unpack the drivers behind its rally, which is also the absolute core theme of this week's FX market. First driver, hotter than expected US inflation data forces markets to reprice Fed policy path. The biggest and most direct driver of the US dollar's move this week was the US inflation data released on Friday. The U.S. May Producer Price Index rose 6.5% year over year, the highest reading since November 2022, and climbed 0.7% month over month, significantly above the market consensus of 0.3%. Following the release, market expectations for Federal Reserve rate cuts cooled once again. Fed funds futures showed markets have pushed back the timing of the first rate cut from September to December and lowered the expected number of rate cuts for the full year from 3 to 1. Persistent inflation stickiness directly lifted the US dollar's real yield, which was the core catalyst for the dollar's fresh surge on Friday. Meanwhile, geopolitical risks provided additional safe haven support for the greenback. Uncertainty over the situation in the Middle East drove sustained capital inflows into US dollar-denominated assets. Second driver, Fed officials deliver coordinated hawkish remarks. Reaffirm higher for longer policy stance on Wednesday this week. Multiple Federal Reserve officials delivered hawkish speeches, further reinforcing market expectations that the Fed will keep interest rates elevated. Fed Chair Jerome Powell explicitly stated in his remarks that inflation remains well above the 2% target, and cutting rates too soon could risk an inflation resurgence. Therefore, policy rates need to remain restrictive for longer. Other officials also echoed this view, noting that current interest rate levels are sufficiently restrictive for the economy, but more time is needed to confirm the disinflation trend, and that further rate hikes remain on the table if necessary. This coordinated messaging from officials directly reversed the market's prior dovish expectations. The US dollar strengthened notably on Wednesday itself, laying the foundation for its strength for the rest of the week. Third driver, US economic data beats expectations, recession risk eases significantly, U.S. May retail sales data released on Tuesday rose 3.2% year over year and 0.4% month over month, far exceeding the market expectation of 0.1%. This reading showed us consumer spending remains robust and the recession risk that markets previously feared is cooling significantly. At the same time, the U.S. labor market remains resilient. Initial jobless claims came in below 200,000 for the third consecutive week, indicating no meaningful deterioration in the jobs market. The ongoing upbeat economic data validated expectations for a soft landing of the U.S. economy, further supporting the U.S. dollar's fundamentals. Fourth driver, global risk aversion rises. Demand for U.S. dollar as a safe haven grows. At the start of the week, global risk aversion continued to climb. Uncertainty over the Middle East situation, renewed global trade frictions, and financial volatility in some emerging markets all drove sustained capital inflows into safe haven assets such as the U.S. dollar and U.S. Treasuries. This safe haven buying supported the U.S. dollar from the very start of the week and served as an important background factor for its sustained strength throughout the week. To sum up, the U.S. dollar's strong performance this week is essentially the result of the resonance of four factors: sticky inflation, Fed policy expectations, economic resilience, and risk aversion. The combination of multiple positive catalysts drove the U.S. dollar's unilateral uptrend this week, making it the absolute core theme of the FX market. 3. Summary and outlook. Overall, the main theme of this week's FX market remains U.S. dollar strength and non-U.S. currency pressure. The dollar's rally was not driven by a single factor, but by the combined resonance of fundamentals, policy expectations, and market sentiment. Next week, the market will see more core U.S. in labor market data. We will continue to track fundamental changes across all major currencies and bring you real-time analysis. Thank you for watching and see you next week.